We're taking a deep dive into stock market predictions. And wow, you really went all out with the source material this time, huh?
Yeah, you've got a really interesting mix here. Academic papers, practical guides, even some code snippets. It's impressive.
I did try my best to track down some good stuff for us to unpack. So I guess our mission, should we choose to accept it, is to figure out how much of this is actually legit. Can we really
Sure.
predict the stock market, or is it all just smoke and mirrors?
Well, that's the million-dollar question, isn't it? And what's fascinating to me is you've got sources that cover both ends of the spectrum, the high-level theory, like those LSTM and ARIMA algorithms, and then the practical side, like how data warehousing can actually make these predictions possible in the real world.
It's like you need both the telescope and the microscope to get the full picture.
Exactly. And speaking of getting the full picture, you included some stuff on the Indian stock market, specifically the BSE Sensex and the Nifty 50.
Right. I figured since a lot of our listeners are really interested in what's happening in India, it would be cool to see how these prediction models could be applied there. So the Sensex and the Nifty 50, they're kind of a big deal, right?
They're like the flag bearers. They give you a sense of the overall health of the Indian economy. The Sensex, for example, tracks 30 of the biggest companies across a bunch of different sectors.
So if the Sensex is up, things are looking good.
Basically, yeah. It's not the whole story, of course, but it's a good barometer.
So it's like taking the temperature. But to really understand what's going on under the hood, we need to dig deeper. And that's where data warehousing comes in.
You got it. And your sources on data warehousing and OLAP, that's online analytical processing, are right on the money. Imagine trying to make sense of the stock market with just a giant pile of numbers. It would be impossible.
Total information overload.
Exactly. Data warehousing takes all that raw data and organizes it into a structured system so you can actually start to make sense of it.
So it's more than just a digital filing cabinet then.
Way more. It's like going from a jumbled box of puzzle pieces to having them all laid out in front of you, ready to be assembled. And that's where OLP comes in. It lets you look at the data from different angles, slice and dice it, to uncover those hidden relationships.
Okay, you mentioned multidimensional earlier, and my brain is already starting to hurt. Can you break that down for me?
Sure. Think of it like this. You're interested in how a particular company's stock is performing, right? OLAP lets you add in all these other layers of information like what industry they're in, what the overall market is doing, even global events, to see how all of those factors are impacting that stock's price.
So it's about connecting the dots, finding those patterns that wouldn't be obvious if you were just looking at the stock price in isolation.
Precisely. And one of your sources, a data warehouse-based modeling technique for stock, actually has this really cool diagram called the lattice of cuboids that visualizes this whole concept. It shows how you can analyze different combinations of factors to create a more complete picture.
That sounds really cool. It's like going from 2D to 3D.
Exactly. You're getting a much richer understanding of the data.
Okay, so we've got our market overview, we've got our powerful tools for analysis, but then you've got these sources that highlight all these unexpected things that can influence stock prices. It's not just about crunching numbers in a vacuum, is it?
Not at all. The stock market is like this super sensitive organism that reacts to everything. It's actually kind of amazing. Take crude oil prices, for example.
Okay.
India is a huge importer of oil, right?
Right.
So when those prices go up, it has this ripple effect across the entire economy. Businesses have to pay more for transportation and energy costs, and that ends up impacting their bottom line, which of course affects their stock price.
That makes sense. So even something that seems unrelated at first glance can have this domino effect.
Exactly. And your sources cover a whole range of these influencing factors.
Yeah.
Interest rates set by central banks, gold prices, government policies, you name it.
It's like the government is this 800-pound gorilla in the market, whether they want to be or not.
For sure. And then you've got global events. You mentioned the Iraq War earlier. Even something happening on the other side of the world can make investors nervous, and that uncertainty can lead to volatility in the market.
Right. So it's all connected.
Absolutely. And political stability within India is another big one. If businesses feel like things are uncertain, they might hold back on investments, and that hesitancy can show up in the stock market.
It's like this intricate web of interconnectedness, and the stock market is trying to make sense of it all in real time.
It's kind of mind-blowing when you think about it. And we haven't even touched on company-specific events like mergers and acquisitions. You've got some great examples in your sources. Tata Steel acquiring Chorus, ICICI Bank's takeover of Bank of Rajasthan. Those kinds of shakeups definitely get the market's attention.
It's like a constant game of chess with all these different pieces in play.
And just when you thought it couldn't get any more complex, you found a source about social media sentiment and its potential impact on stock prices.
Wait, really?
Yeah, it's a relatively new area of study, but it highlights how interconnected our world has become. Our tweets and posts could actually be moving the markets.
That's wild. So you're saying my Twitter rants could be impacting the global economy?
Hey, you never know. It's all part of this giant feedback loop. And that's why your source, a data warehouse-based modeling technique for stock, is so intriguing. It proposes a data warehouse schema that's specifically designed to handle all of this complexity, all of these different factors that influence stock prices.
So instead of trying to make sense of each piece individually, you're looking at the whole puzzle at once.
Exactly. It's about getting a more holistic understanding of what's driving the market's behavior.
Okay, so we've got this incredibly complex system, all these different factors influencing stock prices, and now the million-dollar question, can we actually predict what's going to happen? You've got some sources here that dive into the prediction models themselves, and it's like a whole other world in here.
It is a whole other world.
Yeah.
And it's easy to get lost in the weeds, but that's what we're here for, right?
Wow. To be your guides through the jungle of financial algorithms.
Exactly. So where do you want to start? Simple or complex?
Let's start with the classics. What's considered like the tried and true stuff?
Okay, well, you can't talk about stock market prediction without mentioning technical analysis.
Ah, yes, the art of reading those squiggly lines on the charts.
Exactly. It's all about looking for patterns and trends in historical data, trying to identify those moments where history might repeat itself.
Buy low, sell high, right?
Well, in theory, yeah.
Yeah.
But of course, it's not that simple. Your sources
Right.
talk about moving averages, for example,
Right.
which are a way to smooth out those daily price fluctuations so you can see the bigger picture. You've got the simple moving average, or SMA, and then the exponential moving average, or EMA.
Okay, and what's the difference?
So SMA is basically just taking the average price over a certain period, say 20 days. EMA is similar, but it gives more weight to recent prices, so it reacts more quickly to sudden changes.
So it's like having both a wide-angle lens and a zoom lens on the market.
Exactly. You get both the long-term trend and the short-term movements. And then you've got time series regression, which is a bit more math-heavy, but basically tries to find a mathematical relationship between time and stock prices.
So it's like saying, based on how this stock has moved in the past,
Yeah.
can we draw a line that predicts where it's headed?
Exactly. You're getting it. And these are just the classics. We haven't even touched on the really fancy stuff yet.
Oh, you mean the machine learning algorithms? Those still sound kind of intimidating.
They can be, but they're also incredibly powerful. One that you've got in your sources is LSTM, or long short-term memory.
Okay, I've heard of that one. It's a type of neural network, right?
Yep. And it's particularly good at analyzing sequences of data, like how stock prices change over time. The memory part means it can actually learn from past patterns to make predictions about the future.
So it's like giving a computer a crash course in stock market history and letting it loose.
Pretty much. And you've got a source here, a LSTM-based method for stock returns prediction, a case study of China's stock market that shows how they use this for the Chinese market with some interesting results.
Interesting. So what else is in our arsenal of algorithms?
Well, there's ARIMA, or autoregressive integrated moving average, which is another one that can handle those time series data.
ARIMA. That one sounds familiar, but I'll be honest, I don't fully understand how it works.
It's definitely one of the more complex models, but basically it combines different components to analyze the data and make predictions. Think of it like a statistical detective that's trying to uncover hidden patterns.
Okay, so we've got LSTM, the historian, and ARIMA, the detective. Who else is on the team?
Well, you've got XGBoost, which is known for its speed and accuracy.
XGBoost.
Huh.
That one sounds intense.
It is. It's a real powerhouse, often used in machine learning competitions because it can handle huge amounts of data and still make accurate predictions. You even included a source that talks about combining XGBoost with this technique called N-period min-max to improve its accuracy even further.
So they gave the powerhouse a turbocharger.
Exactly. And then last but not least, you've got SVR, or support vector regression.
SVR.
Mhm.
Another one that rings a bell, but I'm a little fuzzy on the details.
Basically, SVR is really good at predicting continuous values, like stock prices. It tries to find the best line or curve to fit the data, but it does it in a really clever way by maximizing the margin between the data points and the prediction line.
Okay, that actually makes sense when you explain it like that. And these were just a few of the many algorithms out there, right?
Oh yeah, just a small sampling.
Yeah.
There are tons of different models, each with its own strengths and weaknesses, and part of the challenge is figuring out which one is best suited for the specific problem you're trying to solve.
So we've gone through all these mind-blowing models and algorithms. It seems like there's so much potential here. But I also have a feeling there's a but coming.
Yeah, there's always a but, isn't there?
Right. Like it can't be as easy as just picking an algorithm, feeding it some data, and watching the money roll in.
If it were that easy, we'd all be sipping cocktails on our yachts by now.
So what's the catch?
Well, the stock market is like this wild, untamed beast. It's incredibly complex and constantly changing.
So even with all this technology, it's still a gamble.
In a way, yes. And one of your sources predicting stock market index using LSTM, I think it was that one, it made a really good point about data quality.
Oh, right. Garbage in, garbage out.
Exactly. You can have the most sophisticated algorithm in the world, but if you're feeding it bad data, your predictions are going to be worthless.
So it's not just about the tool itself, it's about having the right ingredients.
Precisely. You need reliable data and a good mix of it. Company financials, macroeconomic indicators, technical indicators. Each one gives you a different piece of the puzzle.
It's like putting together a team of experts.
Exactly. You want different perspectives, different insights. And even then, even with the best team and the best data, there's always a chance things could go wrong.
Because the market is unpredictable.
Exactly. And one thing to watch out for, especially with these complex machine learning models, is something called overfitting.
Overfitting. I'm not sure I've heard that one before.
It's like when you study for an exam by memorizing the answers instead of actually understanding the material.
Okay, I've definitely done that.
We
then.
all have. You might ace that specific exam, but you're not really equipped to handle anything new or unexpected.
So the model might look like a rock star in training, but then completely bomb the real deal.
Exactly. And the stock market is full of surprises. It's constantly throwing curveballs.
So where does that leave us? If even these sophisticated models have limitations, how do we make sense of it all?
That's the million-dollar question, isn't it? And there's no easy answer. But maybe that's okay. Maybe the most powerful prediction engine isn't a machine at all, but a combination of knowledge, experience, and, yes, even a little bit of intuition.
So it's not about replacing human judgment, but enhancing it with these tools.
Exactly. These models can help us identify patterns we might have missed, test our assumptions, but ultimately we have to use our own judgment to make decisions.
That makes a lot of sense. It's like having a co-pilot in the cockpit. They can provide valuable information and guidance, but ultimately the pilot is the one responsible for making the final call.
Exactly. And with that, I think we've successfully navigated our deep dive into the world of stock market prediction.
It's been quite a journey. We've covered everything from data warehousing to machine learning to the psychology of the markets.
We've explored the tools, the factors that move the markets, and the potential pitfalls of prediction.
And most importantly, we've highlighted that while these technologies can be incredibly powerful, they're just that, tools.
Yeah.
It's up to us to use them wisely, ethically, and always with a healthy dose of skepticism.
Because the stock market is a force of nature, and while we might try to predict its every move, there's always an element of mystery of the unknown. And that, in many ways, is what makes it so fascinating.